say you sell your company for $1 million and your basis in the stock is $100,000, and you would have a long-term capital gain, assuming you were in the business for more than a year, long-term capital gain, which is taxed more favorably than a ordinary income.
Hello, everyone. Welcome back to Cashing Out, brought to you each week by Hoban Law. With me today, we have a full house in the MJBulls studio. As always, we have our co-host, Dena Jalbert from Align Business Advisory Services. Hey, Dena.
Hey, Dan.
And our legal advisor, Larry Mishkin from the Mishkin Law and Hoban Law. Hi, Larry.
Dan, how are you? Dena, nice to see you guys.
You as well.
And last but certainly not least is an old friend who stopped by, CPA Jim Marty from Bridgewest CPAs. Hey, Jim.
Hi, everybody. Nice to be aboard.
Great to have you, Jim. For our listeners, you may remember Jim. He was a guest on the MJBulls Things to Know When Raising Cannabis Capital series back in September. Jim founded one of the first cannabis accounting practices in the early days of cannabis and built Bridgewest Accounting into one of the largest cannabis accounting firms in the country. If I remember correctly, you have locations in every state where cannabis is legal. So,
yes, we have clients, not so much office locations, but we have clients in every state that has some form of legal cannabis. Do the tax and accounting work for about 250 license holders nationwide.
Wow, that's up, because I think when you were on the show back in September, it was like 200. Good for you, Jim.
That was Oklahoma.
Oklahoma put it over the top. Well, good for you.
A lot of license holders in Oklahoma.
Well, Jim, let's talk today about selling a cannabis business. We're going to keep it pretty loose. And Larry and Dena, if you want to jump in at any time, just please do. I guess I'll get it kicked off. Ask Jim, when you're preparing for an exit, what are some accounting or tax steps that a business owner can take to sort of facilitate the process and maybe reduce their ultimate tax liabilities?
Oh, great question. And lots of ways you can get your business ready for a acquisition. One is you want to have everything in very good order, your tax returns caught up and ready to be shown to the potential buyer once you're under a mutual non-disclosure agreement. I guess that would be the first thing, a mutual non-disclosure agreement. But then having your tax returns up to date, your sales tax returns ready and available. Now, for larger companies, if you can provide audited or CPA prepared financial statements, that can not only facilitate the sale, but it can increase the value of your business because the potential buyer knows that he can rely on the financial statements. Being up to date also in regards to your SOPs, your standing operating procedures, if you're a cultivator, your grow techniques, if you're an extractor, your standard operating procedures and recipes for extraction and finished goods like edibles or vape pens. Having all those in 3-ring binders and up to date and ready to go are very important to help you enhance the value of your business and also expedite the sale.
You mentioned audited financials, and I know that this question comes up occasionally. Can you explain to our listeners the difference between reviewed statements and audited statements?
Yes. Well, the most important concept is whether they're audited or reviewed, the financial statements are the company's financial statements. They're not the CPA firms. And so the CPA firm is opining that the financial statements prepared by management are presented fairly. That's an audited financial statement. A reviewed financial statement is a lesser in scope in that the CPA firm is helping to ensure the financial statements are in accordance with generally accepted accounting, not necessarily passing opinion that they're presented fairly.
I'm assuming unaudited financial statements are more expensive because there's a lot more detail involved.
Well, that's it exactly. The audited financial statements, the CPA firm tests the numbers to make sure that there's no material misstatements. While in a reviewed financial statement, they accept the management's financial statement and put them into the form of generally accepted accounting principles, but don't necessarily take responsibility that they're presented fairly without any material mistakes, as you would in an audit. Some states require audited financial statements, so that's what gets us involved in doing audits. Also, the deals are getting so big now, especially these reverse mergers on the Canadian Stock Exchange, where audited financial statements are required all the way through, or the investors are asking for audited financial statements because the deals are $20, $30, $50 million, some of these deals. If you're on the Canadian exchange, you're going to have to prepare audited financial statements through your filings on the Canadian exchange. And there's even some cannabis companies trading on the OTC, the over-the-counter market in the United States. This has all come so fast. I think everyone on the panel will agree. They never thought that the cannabis industry would come so far so fast, where now we're looking at publicly traded companies coming in with very large sums of capital. I'll let the others make a few comments.
Yeah, Dena, maybe you can jump in. I know you had some questions for Jim.
When businesses are going through a transaction, one of the things that often comes up, and I think this would be good for you and Larry to maybe talk a bit about, is the taxation and tax compliance and then indemnification, and how that can be a risk going into a transaction, making sure that you're compliant. But then also, Larry, maybe you can talk to the tax liability from in a cannabis, whether or not they're up to date on their taxes, and what indemnification that as a buyer you might want to put in, and then as a seller you need to be aware of.
Correct. So as we were talking about previously, that's one of the ways that we make sure that certain representations or certain things are taken care of by the other side, by saying that if they don't take care of it, then they're going to be responsible for all the damage that occurs as a result of their failure. So, typically, and Jim certainly can correct me if I'm wrong, but mostly on deals like this, when there's outstanding tax issues, those tax issues have to be resolved before you can close on the deal. In Illinois, when you're selling a retail business from one person to another, the Department of Revenue issues what's called a bulk sales stop order, and the seller is responsible for getting this document prepared by the Illinois Department of Revenue that verifies that the ownership of the property is changing hands on this date. And boom, that's the deadline. Prior to that date, it's the seller's responsibility. After that date, that's the way the Illinois Department of Revenue keeps track. So we have indemnification provisions in there that'll say, if you've lied, if you haven't done it the right way, if there's liability that spills back as a result, then you indemnify us. And they'll do it the other way to say to the new owners, look, if you fail to collect your sales tax after the closing, and for whatever reason they try to reach back to us, then you're going to indemnify us from that type.
We have something similar in Colorado with our MED, our Marijuana Enforcement Division. They're a department of our Department of Revenue, the tax collection agency of the Colorado government. And before they'll approve a transfer of a license to a new owner, they're going to make sure that all the taxes are filed and paid. Or if you owe money to the IRS, that there's an installment payment plan in place. So very similar to what Larry was talking about. Now, as far as tax liability goes, there's basically two ways to structure the sale of any small business. One is an asset sale and one is a stock sale. As a general rule, the seller prefers a stock sale because they can get long-term capital gains treatment on anything above their investment in their own company's stock. So it's more favorable to the seller. Buyers, on the other hand, are very interested in just purchasing the assets, purchasing the license, purchasing the grow facility, the extraction machine, the fixtures and cash register, the retail operation. And the reason that buyers want to buy assets is there's two reasons. One, it does help break the liability chain on the taxes. So if the seller, a year or two after the sale, gets audited, it should not affect the buyer because they basically have put the assets in a brand new company, breaking the tax liability chain. The other reason they like to buy the assets is because they can depreciate those at the price they purchase them for. So those are some of the things that buyers and sellers look for in a transaction. Usually it's a negotiated item. Most small business sales end up as asset purchases.
Let me take a quick second and do a little business and thank one of our sponsors, Trevitt Hill LLC. Cannabis investors expect the companies that they invest in to generate really big returns. Unfortunately, not all companies reach their expectations. Trevitt Hill's management team works with investors to turn around and in some cases purchase their underperforming portfolio companies. To learn more, go to trevitthill.com. You bring up something that I'm always puzzled by, and that's defining basis, explaining to somebody what's the basis in this company when I exit it and I receive a payment. Is it less the basis that I've invested in the company?
Yes.
It is a confusing subject because basis is a moving target, and the way you calculate it varies based on whether you're a corporation or a partnership, which are the two general forms that you see. But basis starts out with your original investment, and then it's increased for profits of the company, and it's decreased for cash that you take out of the company. It's a lot more nuanced than that, but that's the basic structure. So you start with your investment. It's increased for the profits of the company while you own it, and it's decreased for cash distributions or dividends that you take out. Again, that's very simplified, but that's the concept of basis. And then say you sell your company for $1 million and your basis in the stock is $100,000, and you would have a long-term capital gain, assuming you were in the business for more than a year, long-term capital gain, which is taxed more favorably than a ordinary income. It's about half the tax rate. It varies some depending on your tax bracket and other things like that. And a round number between federal and if you have state taxes, you're 20-25% for long-term capital gains versus about 36% for ordinary income. Getting long-term capital gains treatment on the sale of your business is very favorable. And there's also now, this is brand new too, within the last year, these opportunity zones where you can sell any small business, even a cannabis business, and then reinvest those proceeds in an opportunity zone. And you don't have to pay tax on the profit of your small business. Wow. And then if you stay in the opportunity zone for 10 years, you don't pay any tax on the sale of your business 10 years earlier or the profits on the business in the opportunities. So the opportunities are very exciting. They just came into law at the end of last year. But a lot of the cities and towns, including the city I live in, Longmont, Colorado, we have a very large opportunity zone. And we're looking at doing some exciting things there, like maybe CBD water factories and other things. So check out these opportunity zones. It's a pretty interesting concept, and it's brand new.
Yeah, that's really interesting. So just to wrap up basis, so you said if you had a basis of $100,000 and you sold your company for $1 million, so your capital gains would then be a $900,000?
Yes.
Okay. So in that same line of questions, for an LLC or a partnership, at the end of the year, the members get K1s. Maybe you should explain K1s before I move on.
Well, K1 is a partner's or subchapter S shareholders' proportionate share of the profits for that year.
Okay. Let's just say the company lost money or had a few years of losing money and you were receiving negative K1s. Would that add to your basis?
Well, it actually takes away from your basis because, as I said, even though your basis is increased for profits, if there are losses, they decrease your basis.
Okay.
Because likely you're borrowing money to cover those losses, driving down the value of the company because now it's incurring debt. So losses decrease your basis.
So you don't get a carry forward on those losses in the next...
It depends. That depends on a lot of things. The answer is yes, possibly. You might have loss carry forwards. You might have losses that you're unable to use that carry forward. But needless to say, the U.S. tax code is very complicated, and how you figure those carry forwards and what losses you're able to deduct. It takes a CPA or a tax attorney really to figure those things out.
Yeah.
That's very complicated. The arena of the tax code is basis issues and carry forwards.
Yeah, I think there's a lot of people that just are thinking, okay, I'm going to make this much money when I sell my company, but then they don't really work through all the other details. So Larry, any questions for Jim?
Oh my, I just sit here and take notes when he talks.
Me too.
Larry, are you going to ask you when Phish is going to go on tour again?
As a matter of fact, they announced their summer tour, and they're coming to St. Louis. They're coming to Chicago. So we're looking all over the place. And then, of course, back out at Dick's in September. You just pull in there for the weekend when that happens, don't you?
That's right. They're doing 2 shows at Bonnaroo.
Oh, I heard about that. Yes. That's although Bonnaroo's a young man's game.
When Larry and I aren't doing lawyering and accounting, we enjoy our Grateful Dead and our Phish.
You're not the only one in this industry, that's for sure.
Yeah. When people came to me and said, will you sign our tax returns for the cannabis industry after being lucky enough to see Jerry Garcia 45 times before he died, I said, how could I say no to these people? They're my people.
Yeah,
that's right.
That's part of what motivated me to get into cannabis is my many years of enjoying and touring around with the Grateful Dead. I'm a little older than some of our people listening to this, as they can probably tell by having seen so many Dead shows since Jerry's been gone now for quite some time.
And when you do, they all turn to you and say, wow, you saw Jerry?
Yeah.
I get a lot of that. Makes me feel old.
Dena, do you have anything for Jim before we wrap up?
No. I think you hit on all the major points. Thank you so much for sharing all that knowledge. I think for a lot of people who didn't know some of those kind of key items, that's really helpful. I know those are a lot of things we often have to explain to clients as you go through the process. I think that's really helpful information.
Well, let me say quickly, because I almost always forget, if anybody is listening or any of our listeners have any thoughts or ideas, please email us at connect@mjbulls.com. And I'll have all of Dena's, Larry's, and Jim's contact information on the MJ Bulls website. So if anybody wants to follow up with any of them after the show, you can go to the website. I also want to thank Jamie Humiston for composing the music, as always. Guys, thanks. Appreciate you guys spending the time with me today.
Thank you very much, Dan.
Yeah. And Jim, will you come back on the show as we move along?
Absolutely.
Awesome.
Absolutely.
And Jim, I'll catch up with you down the road.
You bet.
All right. Thanks, guys.
Thank you.
Thank you all.
Bye-bye.